If you're thinking of investing, hold on for a moment. One wrong decision could cost you months, or even years of growth. Most beginners lose money not because of the market, but because of simple, avoidable mistakes. Today I'll reveal 6 beginner investing mistakes, with real Indian examples and strategies to avoid them. Plus, some bonus tips seasoned investors still miss. Welcome to Stock Coney, where we break down investing into clear, actionable steps for your financial freedom. If you're new here, don't forget to check our previous videos and kindly like and subscribe. Several stocks we covered have gone 30% up in just the past few weeks. Stick around, because you don't want to miss insights like that. Mistake 1. Investing without a clear goal. Don't invest just because someone said stocks are the best. Ask yourself, what's your goal? A 3-year house down payment? Or retirement in 25 years? Example, for a 3-year goal, avoid equities. Use liquid mutual funds like Nippon India Liquid Fund or short-term debt funds. For a 25-year horizon, consider Nifty 50 ETFs or blue chip stocks. Mistake 2. Blindly following the crowd. Social media hype isn't a strategy. By the time everyone's talking about a stock, it may be overpriced. Example, during the Paytm IPO, many rushed in without checking fundamentals. The stock fell sharply afterward. Do your own research before following trends. Mistake 3. Panic selling or quick exits without analysis. Suppose you bought Tata Motors at Rs 600. It dropped to Rs 550, then rebounded to Rs 600. Many would sell instantly just to break even. But check why it's moving up. Did their EV segment report strong growth? Are FIIs increasing their stakes? If yes, holding might be wiser. Don't exit without understanding the recovery. Mistake 4. Skipping fundamental checks. Always review key metrics. QOQ revenue, net profit, EBITDA, cash flow, price-to-book ratio, ROCE, and ROE. Example, compare 2 FMCG companies. Hindustan Unilever, consistent double-digit growth, strong cash flow, ROCE above 18%. A small-cap FMCG peer, flat revenue, high debt, weak cash flow. Even if the second looks cheaper, Hindustan Unilever's fundamentals make it safer. Mistake 5. Lack of diversification. Don't put all your money in one sector. Diversify. Spread across automobile, Tata Motors, Maruti Suzuki, healthcare, Apollo Hospitals, hospitality, Indian Hotels Company, chemicals, RT Industries, FMCG, Hindustan Unilever. If hospitality dips, healthcare or FMCG can balance your returns. Mistake 6. Ignoring other asset classes. Equities alone are risky. Build a balanced mix. Consider fixed deposits, FDs, for safety and liquidity, mutual funds, NPS, National Pension System, tax-efficient retirement savings, PPF, Public Provident Fund, tax-free 15-year returns. So what we concluded: avoid these mistakes and you're already ahead of most beginners. Start small, diversify, and stay consistent.